Hey guys, in this tutorial I want to talk to you about car loans. Now, car loans are likely to be the first type of loan that you are tempted with, and please can I encourage you, they're not a good idea, but I'm going to explain to you how they work anyway, just so you know. What we've got here are the details of a typical car loan. A loan amount, so how much can you borrow for a car, varies on the sort of car you've got. Obviously, the banks aren't going to lend you more than the car is worth, but anywhere between $2,000 and $30,000. And in some cases, if your income is high enough, they'll lend you even more than that. Now, one of the problems is when people take on a car loan, they target a car that is way more than they would have spent had they paid cash for it. They go, oh, well, I could only afford $4,000 when I was paying cash, but now that I've got a car loan, I can afford $12,000 or $15,000. Please don't do that, okay? That's the last thing you want to do. If you're going to have to borrow money, please keep it as small as possible. And I am a big fan of going, nope, I'm going to go for a $3,000, $4,000, maybe $5,000 car to start with so that I can either pay cash for it, which is preferable, or if I've got a loan, I can pay it off super fast and then be debt-free again. So $2,000 to $30,000. The interest rate can be anywhere from 5 to 14%. When you take on a car loan, sometimes if it's a fairly new car, the banks will give you what's called a secure loan, and that means that the loan is actually secured against the vehicle. So if you were to default and not pay your loan back to the bank, they would go, right, we're going to take the car off you, we're going to sell the car, and the car will clear most of the loan. And because we've got that security of being able to sell the car, we will offer you a low interest rate. However, if you've got an older car and it's really not worth a whole lot, then they're unlikely to give you a secured loan, and in which case they're going to charge you a much higher interest rate, which can get up towards 14%. The average rate that you will pay on a car loan is around 9%. The loan term, how long can I spread the loan over, is anywhere between 1 and 5 years. There are always fees attached to this, so not only are they going to charge you interest, but they're also going to charge you fees. So there's always a loan establishment fee of somewhere between $295 and $495, so you're leaking money from day one. Then we've got a monthly service fee of $10 per month, and then if you want to pay it out early, they're going to sting you again and charge you probably $195 or thereabouts to pay out your loan early because you've deprived them of some of their interest that they might otherwise have got. So they're the basics of a loan. Let's look at how that appears rather. If we have an example here. So let's just say we have a 3-year loan on an $8,000 car. The $8,000 car is going to cost you 8.99% in interest. You've got fees in there, of course. Your repayments on a monthly basis are going to be $264, which means that over the course of that loan, you are going to pay $9,517 back to the bank, having borrowed just $8,000 to start with. So I'm hoping you can see that having that loan has cost you $1,517. So you've just given that to the bank for the privilege of borrowing the money. Then if we look at it over 5 years, same deal, $8,000, 8.99%. Your repayments though are going to be lower because you spread it out over longer, $178 per month, which is going to cost you at the end of that loan $10,562. So you've just coughed up an extra $2,562. What I want to point out here is that you lose money whenever you borrow money. Everything ends up costing you more. So you don't end up with more stuff, you end up with less because you're paying so much of it back to the bank. People do this over and over and over again with personal loans, car loans, credit cards, where everything costs them so much more simply because they have to add interest and fees on top of that. My advice to you is buy or save what you would be making in repayments for 12 months. Buy yourself a nice little second-hand car that you can run around in for 2 or 3 years, completely debt-free. What you would have been paying in repayments, save that, and then buy yourself a nicer car in 2 or 3 years' time. Do it debt-free, and in the meantime, you're saving yourself these huge amounts of interest.